How to understand commodity spreads simply. Imagine you're watching two related prices move and wondering how their relationship can tell you something about the market. That's what understanding commodity spreads is all about. It's not just about buying or selling one commodity, but about comparing two related contracts at the same time. This approach helps you see how their prices change relative to each other, which can be a smart way to trade with less risk. A commodity spread involves holding two positions at once, one where you buy a futures contract and another where you sell a futures contract. These are called legs. For example, you might buy a futures contract for wheat delivery in July and sell a futures contract for wheat delivery in December. The goal is to profit from how the price difference between these two contracts changes over time. If you think the difference will grow wider, you buy the spread. If you believe it will narrow, you sell the spread. The price of the spread is just the difference between the prices of the two contracts. Traders watch this difference closely because it moves based on supply, demand, and seasonal factors. For instance, if wheat prices for July are going up faster than December, the spread widens. If the opposite happens, the spread narrows. This way, traders can make money even if the overall market doesn't move much. Most spreads are traded on futures exchanges as a single trade, which reduces the risk of one leg not executing. Since both parts are bought or sold together, it's easier to manage. Margin requirements for spread trades are often lower than for trading individual futures contracts because the two legs tend to offset some risk. There are different types of spreads. Calendar spreads involve the same commodity but different delivery months, like buying July wheat futures and selling December wheat futures. Intercommodity spreads involve two related commodities, such as buying crude oil futures and selling heating oil futures, which are connected through their economic relationship. Option spreads involve options on the same commodity but with different strike prices or expiration dates. Using spreads allows investors to gain exposure to the relationship between commodities with less risk than outright buying or selling a single contract. They can be used to hedge existing positions or to speculate on how supply and demand will shift between related commodities or different contract months. To sum it up, understanding commodity spreads is about recognizing that you are trading the difference in prices between two related contracts. Your goal is to profit from how that difference changes over time. This method can help reduce risk and open up strategic ways to participate in commodity markets. It's a smart tool for traders who want to focus on relative price movements rather than just the absolute prices of commodities.